INBrief with Glen Foster, Head of Risk and Senior Portfolio Manager at Atrium. Welcome, Glen.
Thanks, James.
2023, it's seen so much volatility and a resetting of rates that by historical standards has been pretty quick. How would you summarise the changes across the capital markets as a result of that environment?
Yeah, well, 2021 through to 2023 has been a pretty extraordinary time coming off an extraordinary period of loose monetary and fiscal financial conditions. And so the rapid tightening of that is going to have a flow-through impact. But what's interesting as well is that coming off the pandemic, where there are a lot of savings buffers built up and there was a lot of fiscal support, it's actually taking longer than what you would have thought for these tightened financial conditions to make an impact. So obviously you see it in the bond market with higher interest rates. But what's interesting about that is while bond markets are kind of pricing in a slowing economy and a risk of recession, equity markets not so much. And earnings, consensus earnings for equities are still well above trend, and that's what I find particularly interesting right now.
Investors need to take a view about what exactly is the regime into which we've entered. Do you think enough evidence exists to draw conclusions, or is there still uncertainty over the patterns into which markets are settling? With obviously a bit of a geopolitical, day-to-day, short-term buffeting possible.
Yeah, I mean, there's totally evidence for a shift in regime, and when you go from a zero interest rate regime, there's sort of only one way to go for interest rates, and that's
a lot of home borrowers might not think that way.
Yeah, well, if you go back just before interest rates started rising, there was some pretty obvious things on the doorstep. If you've got interest rates, cash rates at zero, bond yields negative in real terms, but you've got a risk of inflation from, initially it was supply chain effects, but coming off the pandemic, but then also Ukraine and energy markets. So a risk of inflation at a time when the expected return from bonds being negative or zero at best, had big implications for this year and volatility.
We're here, of course, at the Inside Network's Alternatives Symposium. So in building a portfolio, do traditional construction theories still apply and the way people have thought about correlations? Or should investors really throw everything in the air and rethink assumed correlations and investment principles?
Yeah, I think the one thing that's always been the case is that correlations are not static. I mean, the correlation between equities and bonds going back hundreds of years, it tends to be either really strongly negative or strongly positive, and it's never zero. So if you take the long-term view of that correlation and assume it's zero, which is probably the average, you're pretty much always going to be wrong. So what's important now is you don't rely on that correlation being zero, and perhaps you actually expect that it's not going to be the same now as it was in the past, and you're seeing a positive correlation between equities and bonds, which is why the Alternatives Conference is important, because you need alternatives to bonds to be able to diversify your portfolio in that environment.
Closing out 2023, heading into 2024, very, very quickly it feels. What do you see at Atrium are the most attractive opportunities that will emerge or are there as we head into the new year?
Yeah, it's a really good question, a topic of a lot of discussion, and something that we tend to call the catch-up trades. So, there's a lot priced into growth equities, and particularly that was the case with low interest rates and therefore high fair values for stocks or for companies that are growing. But I think we're past that. That's not where the attractive opportunities are now. The catch-up trades are more the rest of the market, the things that are still quality but cheap. And you see that in the smaller end of the market. You've got 7 stocks in the US driving all of the returns, but there's a lot of other stocks that are much more reasonably priced and will actually benefit from normalisation in rates. And there's also other economies too. So the emerging markets, there's a lot of cheap assets there and strong growth opportunities. So I think if you look outside the US and outside growth, that's probably where you're going to see more opportunity.
And conversely, what keeps you and the risk team at Atrium awake at night in terms of the potential risks coming over the horizon?
Well, I think an obvious one is commercial property. That's been a risk for some time, and you're starting to see that play out in market pricing and transactions actually being forced on the holders of these assets at prices that maybe they prefer not to accept. But and the other, whenever you see a lot of money flooding into one area, it can be a little concerning as well. And perhaps in Australia, that's private credit. So there's definitely a big spectrum of the quality of some of these strategies, and so it's a bit buyer beware for private credit. Know what you're exposed to.
Glen Foster, Head of Risk and Senior Portfolio Manager at Atrium, thank you very much for being with us.
Thanks, James.